What if I told you the biggest threat to Bitcoin right now isn't regulation, isn't hacks, and it's not even retail panic? It's the banks. And they're quietly pushing Bitcoin toward a mathematically inevitable death spiral land. Almost nobody sees it happening, but once you understand the mechanism, you'll never look at the price the same way again. Because behind the scenes, the exact same structure that destroyed empires, bankrupted countries, and wiped out hundreds of companies is now attached to the largest corporate Bitcoin holder on Earth. And if this structure activates, it creates a loop. Sell gives price drops, gives forced sell, gives price collapses, gives repeat. Sounds dramatic, right? Stay with me, because once you see who benefits from this spiral, your entire view of Bitcoin's price action will flip upside down. Here's the first thing you need to know. Bitcoin holders think the biggest threat is volatility. Wrong. The real threat is liquidity, starvation. There's a company holding more Bitcoin than most countries, but it also owes billions in obligations that must be paid in cash, not Bitcoin. And that single detail is what creates the opening banks are exploiting. But here's where it gets interesting. This company survives only as long as two things remain true. Their stock trades above the value of their Bitcoin. They can keep raising cash from that premium. If the price ever flips, meaning the stock trades below the Bitcoin behind it, their entire model reverses. Overnight, instantly. And that's where the death spiral begins. Why? Because now they can't raise cash through stock. So to pay obligations, they must do the unthinkable, sell Bitcoin. And here's the sinister part. Someone is making sure that threshold stays dangerously close. Banks aren't stupid. They know exactly where this threshold is. Below that line, Bitcoin becomes cheaper than Bitcoin. Let that sink in. If they can suppress the stock price just enough, they can accumulate Bitcoin through a back door without paying the real market price. But it gets even crazier. This isn't new. This tactic destroyed the Ottoman Empire, Greece, in 2010. Hundreds of tech startups in the early 2000s, dozens of resource companies during commodity crashes. Every time the pattern was identical. Debt tied to an asset gives asset drops, gives forced selling, gives total collapse. The same mechanical structure. Only now, the asset is Bitcoin and the scale is global. So who's doing it today? Let's connect the dots. Right now, major banks issue negative reports about Bitcoin. Hedge funds openly short the company tied to Bitcoin. Liquidity dries up at very specific price levels. Trading desks suddenly pile shorts when Bitcoin hits key premiums. Coincidence? Maybe. But the behavior lines up perfectly with the playbook of a controlled liquidity squeeze. Because, here's the twist. You've been told banks hate Bitcoin. Wrong. Banks don't hate Bitcoin. They hate paying full price for Bitcoin, and the only way to buy it cheap is to pressure the one entity holding more Bitcoin than anyone else, until they're forced to sell. This isn't emotional, it's mathematical. And that's what makes the next part terrifying. This company has built a cash bunker, a reserve that buys them time. Roughly 21 months worth. After that, no more buffer, no more protection, no more insulation from liquidity pain. If banks can keep the stock under the critical premium level long enough, the Bitcoin sales begin. And once the selling starts, the spiral feeds itself. But here's where it gets really interesting. You might think banks need to coordinate. They don't. All they need is shared incentive. If the stock falls, gives the company can't raise cash, gives. They must sell Bitcoin, gives Bitcoin price drops, gives traders short, gives more downside, gives more forced selling. Everyone profits along the chain, except the people holding Bitcoin. This is why the price hasn't exploded to $200,000. Not because Bitcoin is weak, but because someone needs it lower for just a little longer. But there's one more piece you haven't heard yet. There's a second, almost invisible lever. Index removal risk. If the stock gets pushed far enough down, Index funds are forced to sell billions. Not because they want to, because their rules require it. Now picture this. Indexes dumping gives hedge funds, shorting gives banks, issuing negative outlooks gives the company unable to raise, gives Bitcoin being sold into the market. That is the definition of a systemic death spiral. But here's the part nobody is talking about. If this were a coordinated attack, the spiral would have already begun. Instead, the price keeps bouncing. Right at the levels where liquidity shortens and longs re-enter. This tells us one thing. Someone powerful is also defending the price. Two forces, one pushing Bitcoin down, one quietly holding it up. This is why Bitcoin feels stuck. Neither side wants to lose, but time is not neutral. As the cash reserve drains month after month, the pressure grows. When the clock runs out, the company has only one option left: sell Bitcoin. And the sell volume required to satisfy obligations? It's enough to shove the entire market down 20 to 30% instantly, which then triggers liquidations, which trigger more selling, which trigger more shorts. You get the idea. But here's the unexpected part. The same death spiral that could crush Bitcoin in the short term is what could send it to never-before-seen highs afterward. Why? Because once the forced selling is done, once the cheap supply dries up, and once institutional hoarding completes, Bitcoin becomes structurally scarce in a way the market has never experienced. This is why the bank's endgame might not be destruction, but accumulation. And that means the death spiral may actually be the accumulation spiral. So here's the real question. Will the banks succeed in pushing Bitcoin into the spiral? Or will the defenders win and flip the entire system on its head? In my next video, I'm breaking down the exact price levels that trigger this spiral and the hidden signal traders used to detect institutional pressure before it hits the chart. Tap subscribe, because once you see those levels, you'll never trade Bitcoin blind again. See you in the next one.